Topic 27. Transferring mortgages. By the end of this topic you should have an understanding of converting to a different mortgage with the same lender, remortgages, property moves, transferring equity, redeeming a mortgage early, making capital repayments during the term. Topic 27.1. Changing the mortgage. If a borrower wishes to reduce the cost of their mortgage or take out a different type of arrangement, or is reaching the end of a special rate, it is an opportunity to review mortgage arrangements and look at what new deals their existing lender can offer, or what other lenders have available. Moving the mortgage to another lender is not always the best option, with reductions in monthly repayments achieved by remortgaging could be outweighed by fees charged on the new arrangement by the new lender. In addition, some lenders offer loyalty deals to encourage borrowers to stay with them. Considerations for switching to a new arrangement with the existing lender. Application and/or product fees for the new deal. Early repayment charges might apply to the original arrangement, although lenders might waive the charge if a new offer is taken up. Switching with the original lender does not involve the substantial legal costs, and no formal valuation will be required unless a significant increase in borrowing is proposed. The process should be much quicker than switching to a new lender once approval has been given. A lender can waive the normal affordability checks in favor of a proportionate affordability assessment for consumers who are up to date with their existing mortgage and want to switch to a more affordable one without borrowing more. There are also transitional arrangements for borrowers who took out a mortgage before the 26th of April 2014, non-MCD regulated, and wish to change their mortgage without borrowing more. In this case, the lender is not required to carry out an affordability assessment. Topic 27.2. What is involved in remortgaging? A remortgage is a replacement loan for one already in force with the original lender or with a different lender. Nearly all mortgage deeds have clauses allowing a further advance to be made without having to draw up a new deed, and most lenders will allow an existing borrower to move to a new mortgage product without the need for a remortgage. A remortgage is an entirely new arrangement, and the new lender must apply MCOB rules to the application, which must be suitable and affordable with normal checks carried out, unless the remortgage is for the same amount, in which case the lender can apply a proportionate affordability assessment. The lender will need to be satisfied that the borrower can maintain the mortgage repayments and that the property is adequate security for the mortgage. What is involved in the remortgaging process? Remortgaging mirrors in many ways the normal mortgage application procedure, including the rules on advice and execution only, and will now be an MCD-regulated mortgage. The lender needs to gather the necessary status and security information. Details of the existing mortgage have to be confirmed together with statements going back over a reasonable period of time. Once the lender has assessed the application as acceptable, a formal offer of advance will be issued. Assuming the borrower is happy with this, the conveyancing work can start. The solicitor acting for the borrower will arrange to pay off the existing mortgage from the proceeds of the advance check, alongside any other costs, fees, or expenses involved. What issues does the borrower need to consider? Borrowers should be aware of the following issues before remortgaging. Terms and conditions. The borrower should make sure they understand the terms and conditions that apply to the proposed new arrangement. Often there are tie-in conditions with financial penalties for early redemption, or other conditions that may not be immediately obvious. Fees and other costs. There are likely to be fees and costs associated with remortgaging unless the lender offers free valuations and legal services. Costs would include application and/or product fees with the new lender, valuation and conveyancing fees, potential redemption penalties from the existing lender, and legal processes such as local authority searches that would have to be repeated. In view of this, the borrower should consider the impact of the costs on the overall arrangement. Debt consolidation. Replacing an existing mortgage with an increased loan to consolidate other debts can be a money saver in the short term, as mortgage rates are lower than other forms of borrowing. However, the borrower will need to consider that they will be paying interest on the consolidated debt until the end of the mortgage term, which will usually be longer than the original loan it replaced, and the costs will be higher. Lender will need to take reasonable steps to ensure the consolidated loan is repaid on completion of the mortgage in the affordability calculation. Moving unsecured loans to secured status can be risky for two reasons. 1. The borrower's equity in the property will be reduced, which could reduce their options if they wanted to move in future. 2. If the borrower has difficulty meeting monthly costs and defaults on a mortgage, the lender might commence possession proceedings, whereas this would not happen with an unsecured loan. Financing non-property purchases. Using a remortgage to raise additional money for other purposes can be attractive as mortgage rates are generally lower than other forms of borrowing. However, the borrower will be repaying the increased borrowing to the end of the mortgage term and could be higher than a short-term loan. Higher lending charge. Increasing the level of borrowing may result in an LTV in excess of the new lender's threshold for an HLC. In this situation, the HLC should be taken into account when calculating the overall benefit of the new arrangement, and that already paid to the current lender will not be refunded or transferable to the new mortgage. Any second charges will either need to be settled on completion of the remortgage, or the second charge holder will need to agree to postpone their charge to allow the new lender to establish a first charge on the property. Issues to consider in relation to the existing mortgage. Early repayment charges on the existing mortgage. If the existing mortgage is based on a special deal, the borrower might be charged by the lender for transferring to another lender during the term of the special deal. Administration fees. Most lenders charge a fee to close a mortgage account. Loyalty offerings. Some lenders offer borrowers special loyalty bonuses after a specified period to remain with their existing lender. Topic 27.3. Property moves. Moving home is an opportunity for the borrower to reassess existing arrangements and decide whether better terms can be secured elsewhere. Factors that could influence the decision include the existing lender's service standards, the existing lender's interest rates compared with the market, special deals available elsewhere, and the existing lender's efforts to retain the borrower, the comparative costs and attractiveness of offerings from new and existing lenders. Many lenders offer a portability option where they would effectively be transferring that mortgage to the new property, although technically the original mortgage would be redeemed and then another mortgage arranged. Any increase in borrowing would be on a deal offered at the time, and any reduction to mortgage would usually incur any early repayment charge applicable to the mortgage. This could save a significant amount in early repayment charges compared with arranging the new mortgage with a new lender. When porting a mortgage, the borrower will have to submit a new application and the lender will be required to carry out an affordability assessment, although MCOB 11.6 does allow the lender to waive affordability checks if there is no increase in borrowing and the change will not impact on affordability. Some lenders insert a condition requiring the borrower to pay the standard early repayment charge when the original mortgage is redeemed if there is a time lapse between sale and purchase, and will then refund it when the new loan is completed. Considering whether to move. Depending on the reasons for their wish to move and the degree of flexibility they have, the owner should weigh up the benefits of moving compared with the costs involved. Common reasons for moving include relocating as a result of a change of job, family circumstances, or personal preferences. If moving, for example, due to requirements of more space, or extra bedroom due to family circumstances, it may be more cost-effective to add an extension onto existing property than the value of a new property alongside the costs of legal and mortgage fees. If you're considering a career in mortgage advice, you've come to the right place. This was the first 3 sections of topic 27.1 of the mortgages syllabus towards the CeMAP qualification. This is just one of many videos we provide as part of our comprehensive CeMAP Home Study Package that comprises a diverse selection of instructional videos covering every topic within both CeMAP 1 and CeMAP 2 syllabus. These videos serve as an integral component of our robust training materials, strategically designed to facilitate effective learning and preparation for the examinations. In addition to the video content, our package includes an array of additional resources such as audiobooks, revision guides and specimen papers, all aimed at providing comprehensive support to ensure success in the exams. If you have any questions or uncertainties regarding CeMAP, feel free to drop them in the comment section below. We're here to help, and we'll get back to you with the information you need. For more in-depth information or to book your CeMAP training course online, visit our CeMAP course pages on our website. If you prefer a chat, don't hesitate to call our friendly learning and development team on 020-8443-2888. They're here to discuss any queries you may have or to assist you in booking your course over the phone. We also have a number of videos on our channel talking you through the qualification and becoming a mortgage advisor. We will link this in the description box below and will appear on the screen now. And don't miss out on valuable insights. Subscribe to the Future Trend YouTube channel and turn on post notifications. This way, you'll be the first to know when our upcoming CeMAP videos are released. Let's shape your future in mortgage advice together. Future Trend Financial Training, accredited CeMAP learning and support provider for the LIBF.